I'd like to talk about how we think about high-yield bond investing at AAM. Recent price corrections and subsequent recoveries in the U.S. high-yield bond market have been abrupt. This pattern has been consistent in recent years and warrants the attention of prospective insurance company investors who are focused on generating long-term income and also have the benefit of being stable sources of capital during periods of volatility. More recently, for instance, in a 4-week period beginning in early July, severe outflows from high-yield mutual funds made headlines. Total outflows for the month ended up at over $12 billion, and the exodus was highlighted by the final week of that stretch, which set a record for the highest one-week outflow of all time at over $7 billion. To put that in perspective, that $7 billion loss was more than 50% higher than the previous one-week record that took place the last time outflows hit the market in 2013. The end result of this selling pressure was that the high-yield bond market lost almost 2% of its value. Average yields for the broad market approached 6%, which was almost 1% higher than levels before the correction took place. With the benefit of hindsight, we can now see that the market then rallied, and it only took 7 weeks for the market to fully recover. In other words, the full cycle of the high-yield market correcting and then fully recovering to previous levels only took a period that was just short of 2 months. So why is this event important for insurance investors? After all, it's only one data point. It's important because it highlights what appears to be a structural shift in the high-yield bond market that's causing short-term disruptions. And that can be advantageous for insurance investors that can provide liquidity to the market in periods like today, where corporate fundamentals remain healthy and the outlook for defaults remains benign. So what changes in the market have occurred? Following the financial crisis of 2008, increased regulatory capital requirements have led to a significant reduction in bond dealer market making capacity. Recent data shows that bond dealer corporate inventories, which are really a gauge of their ability to provide liquidity to sellers, are at an all-time low relative to market size. Bond dealers currently hold around $40 billion of credit-related bonds in inventory, which is less than 0.5% of the outstanding market. That compares with the peak holdings of around $230 billion pre-crisis, which was about 4% of the market at that time. To further illustrate the point, this reduction in market-making capacity has occurred during a period where the high-yield bond market has doubled in size, growing from $650 billion back in 2007 to about $1.3 trillion today. During that same period, bond mutual fund and ETF assets, which are traditionally more retail-oriented barometers, have more than doubled in size. So you have a shrinking pool of available liquidity, coupled with a growing pool of retail assets that can certainly be a cause for more volatile flows. Put together with the prevailing environment of suppressed global interest rates, along with aging demographics, there continues to be a steady institutional demand for income-producing assets that's recently helped the duration of those downturns. For instance, if you look at over 30 years of market data where the high-yield market is corrected, and I define that as periods where the market lost more than 2% of its value, the average correction period from beginning to end prior to the financial crisis was between 7 and 8 months. Following 2008, however, the average correction and recovery time was almost cut in half to around 4 months. Now, there might be other forces at play besides dealer inventories and retail fund flows, but the fact remains that recent disruption periods have been shorter. Insurance investors with longer-term views, as well as established sources of capital, can be opportunistic whenever these disruptions occur by providing the buying power that the bond dealers no longer offer. For that reason, we recommend that insurance companies who are considering an allocation to high yield should address their guidelines and receive board approval well in advance so they're in a better position to take advantage of those opportunities whenever they arise. For more information, please contact your AAM portfolio manager or sales representative.